named Wall Street's best deal maker by Forbes back in 2019. How are you going to make yourself #1 in 2021? It's all about software valuations for you. You actually think, what, we're undervalued? I haven't heard of a single place that's undervalued right now.
Well, first of all, thanks so much for having me. Isn't this great to do an interview in person instead of on Zoom, be in LA?
Yeah.
Wearing a tie, outside, seeing old friends and new friends. So thank you so much for having me. Look, software is, you have to think about the digital world completely different than the physical world for both investing and solving today's biggest problems. When you look at software companies now, the ones that are profitable in the public markets, they're on average trading at about a 30 PE. These companies are growing earnings at 20% versus the S&P growing earnings at 5%. And they're really becoming the ultimate business of companies. They're taking over the world, really. So these are some of the best assets to be investing in.
Why is there a distortion, though, in the way that people are valuing these companies? Is this goes back to the idea that the growth for some is maybe just a little bit too much for others?
It's really interesting, the dichotomy in software now. The unprofitable companies that are growing revenue in excess of 30% have revenue multiples that can be justified only if those companies continue those growth rates and get profitable in year 3 or 4. Operationally, the world doesn't work that way. That's an assumption that investors are making. Now, the companies that are profitable, the investors get to see what it's about. And they're going more for the high growth, unprofitable business than appreciating the profitable, consistent growers of today.
Of course, we've seen big tech in its way sometimes acts as, a risk-off kind of sentiment. You go into it when you're a little bit nervous, but then again, when inflation, when interest rates, people panic about them, they start to sell it off. Do you think the growth stories that you see, the software companies that you like, can weather any inflationary pressures, any of the bouts of volatility?
Well, first of all, absolutely yes. When you look at enterprise software, especially business-to-business enterprise software, they basically take inflation out of the system, because you can replace high-cost labor with business processes that automate that labor so that people can spend their time doing other things. So that's first. Secondly, since they have that role in the world, when you think about it, you can increase prices as a software company to match that inflation. So they're a good inflation hedge for basically what they do as a business model.
There were some secular tailwinds, though, that were a big part of that. A lot of corporations, a lot of enterprise customers that weren't really up to speed with the transition that we saw during the pandemic. That was a big benefit, but that's not necessarily a benefit that's going to last for all of these companies.
That is really well said. That's a benefit that's going to last for a long time, and it's going to be accelerated. See, all these technologies were there already. How to learn online, how to distribute learning to many public inner city schools where you lose the students in the summer instead of being into, all that was available. What the pandemic did, it forced executives and leaders to think about the digital world differently. And what did the world do? They embraced these technologies. Now we're not going to go back to the physical world. This is going to keep going. We had a step function increase in this. Now, talking about inflation and interest rates, that's a worry for high-valued stocks. I get it. That's economics 101. If inflation goes up, then their discount rate changes and you value these companies less. I don't buy it. Think about it. If you own a company and it's worth $10 million and you're about to sell it, and inflation and interest rates go up, and the buyer calls you and says, now the price is $9 million because interest rates just went up, you're not going to do that deal. You're not going to sell that company, especially if you have a high-growth, great company.
Talk to us about doing deals at the moment. Talk to us about consolidation. Are we going to see software enterprise companies eating each other up?
Big time. There's so much activity right now. There is more deal opportunity than there is capital. In the last 12 months, we invested $30 billion in equity pursuing these deals. One of the big trends that we're seeing is industrial buyers, as they look to transform their companies into software companies. They're doing that organically, but they're doing that through M&A, and that's going to be the next force of M&A in the market at scale.
At scale, and there's a lot of sort of nuance to the M&A right now, particularly with regards to SPACs. You did your first SPAC deal this year, is that right?
We did.
Yeah.
We did our first SPAC, and we merged with what we feel is one of the best software companies in the world, IronSource. They run the entire business. Think about this tab. They run the entire business of an app developer. with a focus originally on the gaming industry. And the historical numbers that they've put up, over 30% EBITDA margins, and in the past, over 50% revenue growth, those metrics combined is something that you don't see very often.
SPACs, though, have had a bit of a torrid 2021. They were all that, the hype, the glory, and then suddenly it whittled away. We started to question some of the growth, we questioned some of the regulation around it. How did you find the process? Do you think regulation is fine-tuning to the world of special purpose acquisition companies?
Well, we found the process great. Very quickly after we closed our SPAC, we were able to merge with what I said is one of the best software companies in the world. We love that team, we love that company. We really like the model of SPACs. If you can combine, like we try to do at Thoma Bravo, the best of the public markets and the liquidity and the great long-term investors that the public market gives you, with at the same time, the best that private equity has to offer. A long-term partner and the alignment of interest between the SPAC sponsor, which we feel is very important going forward, and the underlying investors.
We only have a little bit of time here, but I want to segue from that to the idea of democratization of finance, something I know you're also here to talk about today.
Big time. We have to get as many people as possible from all segments of society playing the game. That's one of the problems is if you have big segments of society, whether it's the retail investor, whether it's based on location, whether it's based on race, whether it's based on what have you, not playing the game, the system can collapse. Yeah. And that's not a good thing. So the more we can get everybody in it, the better.